Global uncertainty is expected to keep the Reserve Bank at bay when its board meets to consider interest rates tomorrow. Most analysts expect them to stay where they are, despite signs that some parts of the economy are gaining momentum. Here's Philip Lasker.
As the Reserve Bank meets to consider interest rates, there doesn't appear to be much concern about the uncertainty in Canberra and the prospects of a new political order. The concern comes from that other capital, Washington DC, where President Barack Obama was making the most of some better-than-expected jobs numbers.
The evidence that we've seen during the course of this summer and over the course of the last 18 months indicate that we're moving in the right direction. We just have to speed it up.
But speeding it up isn't as easy as it sounds for US policymakers who are short of ammunition to boost the economy.
I think the biggest concern in the US at the moment is the possibility of a renewed downturn in housing activity and prices, and that could be the trigger for a double-dip recession. But it now looks as though there'll be just enough activity elsewhere in the US economy to forestall that possibility.
Households are starting to see a little bit more coming in. That's a plus. Certainly, that may also help improve confidence going forward. That might get the households out to spend a little bit more.
The Reserve Bank won't be counting on a sustained US recovery just yet, but it does have today's solid domestic data to consider following last week's stronger-than-expected economic growth numbers. Job ads on the internet and in newspapers rose more than 2% in August, the biggest gain in 6 months, to be over 36% higher for the year.
We continue to see a recovery in job ads, which I would expect to see in the second half of this year. Then that should pick up an unemployment rate, and the unemployment rate should start falling again. So we're expecting unemployment to stay above 5% for the next 4 months, but in 2011 it's likely to fall towards 4.5%.
A strong jobs market usually means higher interest rates, but not this month.
There was no indication of renewed inflationary pressures in the national accounts themselves. The labour cost data have been quite encouraging, and I think all that gives the Reserve Bank time to wait and see whether inflation is likely to re-emerge above the top end of the Reserve Bank's target band again, either later this year or perhaps more likely in 2011.
In keeping with that trend, the latest inflation measure from TD Securities saw a modest rise in August of 0.2%. But the inflation train is coming through a massive resources boom.
Strong exports, strong terms of trade, driving investment, driving profitability.
And driving interest rates higher.
And they'll probably wait till November to see the next CPI, and I think they'll do at least one, if not two, rate moves before the end of the year.
So tomorrow's RBA in action looks like the calm before the storm for borrowers.